Hello everyone and welcome to today's video. Today, we're going to dive into the world of cryptocurrency with a special focus on Bitcoin. Whether you're completely new to the space or have dabbled in it a bit, this video will help you get a grasp on Bitcoin's historical price data, the risks involved in the crypto space, and how it all compares to traditional money. We'll also touch on stablecoins, crypto exchanges, and the importance of securing your assets with cold wallets. What is cryptocurrency exactly? Let's start with the basics. Cryptocurrency is a digital money that exists only online. It can be exchanged for fiat currency, but unlike the dollars or euros you're used to, cryptocurrencies are decentralized and aren't controlled by any central authority like a bank or government. Bitcoin, for example, runs on a technology called blockchain, which acts like a digital ledger that records every transaction. This decentralized nature makes cryptocurrency secure, transparent, and almost impossible to counterfeit or duplicate. But like any investment, cryptocurrency isn't without risks. The digital nature of crypto makes it a target for hackers, as hacks and phishing scams are very common in this space, where people attempt to steal your funds by tricking you into revealing sensitive information. I'll show you guys how to take steps to protect yourself, which I'll cover a little bit later. Now, how does cryptocurrency differ from the traditional money or fiat currency that we're used to? Unlike fiat currency, which is issued by governments and can be printed in literally unlimited amounts, many cryptocurrencies like Bitcoin have a fixed supply. For example, there will only ever be, I think it's 21 million Bitcoins in existence. This limited supply can make Bitcoin more attractive as a store of value, often being referred to as digital gold. Additionally, cryptocurrency can be physically damaged or destroyed unlike cash. Now that we have a better understanding of what cryptocurrency is and how it operates, let's take a closer look at Bitcoin's historical price data, which can help us understand its market cycles. As you can see in this chart, Bitcoin has gone through several major cycles over the past decade. Each cycle typically lasts about 4 years and includes a massive rally followed by a significant decline. For instance, there's an 87% decline from, what year was this? 2013 going into 2015. So the decline doesn't last very long. The buying opportunities, they all present themselves within here, and it doesn't last very long. But the rally was almost 12,000% increase in price over the course of 2015 to 2018, so 3 years. So the dip only took about a year, which was the hard part, the pain, and it just presented numerous buying opportunities throughout the entire 12,000% rally over the 3 years. And we see it time and time and time again. This is what makes Bitcoin and other assets in the crypto space very appealing to investors. Large declines, this causes balance within the markets. At least that's just the way I look at it, right? Bitcoin in 2018, after this huge rally, experienced an 84% short, followed by a 2,200% increase in price. And then we did it again in 2021, where Bitcoin shorted 77%. So as you can see, each and every single one of these declines are getting healthier and healthier and healthier. Every time the market dips, we never trade below the last cycle low. So you can see this is a cycle low back in 2011. This is a cycle low back in 2015, so 4 years literally between them all. This is a cycle low in 2018, and this could possibly be our new cycle low now. We never, ever, ever trade below the previous cycle low. And the reason why I keep bringing up cycle lows is because we never trade below them or break any real structure, which means we just continue healthily. Funny enough, you might look at this and think to yourselves, well, Bitcoin is dropping 80% plus every time. How can that possibly be sustainable? That's exactly it. That's the paradox of Bitcoin. No matter how low we go, we still end up recovering just based off simple market psychology. A lot of people are selling their positions just because it's still a fairly speculative and new asset. We've only been trading publicly for, well, not publicly, but Bitcoin's only been in existence for 15 years. Well, 14 years going on 15. It's not something that many people not in the crypto space, I should say, that are extremely confident in, like somebody who's been in this for a very long time. So just to keep that faith in your asset, just know we never break any real significant structure. All we do is balance each and every single bull run out, and that's all it is. You trade 11,000% higher, you best believe we're going to eventually sell off at some point. And it happens time and time again, which creates the balance and health of Bitcoin. Now that we know how cryptocurrency such as Bitcoin works, let's look at stablecoins and their roles in the crypto space. While Bitcoin and other cryptocurrencies can be highly volatile, there's another type of crypto known as stablecoins. Stablecoins are designed to maintain a stable value by being pegged to a reserve of assets like the US dollar. This stability can be a powerful tool for traders and investors. For example, during periods of high volatility, you can convert your holdings into stable coins to protect your assets from sharp price swings, essentially using them as a safety net. But there's more to it than just stability. Traders can profit from the fluctuating prices of cryptocurrencies by timing the market. For instance, if the dollar price of a stablecoin rises, you can exchange it for other cryptocurrencies when their prices are low, maximizing potential gains when the market recovers. Another strategy is to convert your idle money, funds that aren't actively being traded, into stablecoins, and then use those stablecoins to buy other assets when opportunities arise. This way, you're not really depositing more money into your trading account. Instead, you're making your existing funds work harder for you by capitalizing off market fluctuations without needing to worry about the volatility affecting your base value. In essence, stablecoins provide a flexible tool for managing risk and seizing opportunities in the ever-changing crypto market, allowing you to stay engaged without the constant need to inject more capital. To buy or sell or trade cryptocurrencies, most people use crypto exchanges like Coinbase or Binance. While these platforms make it easy to enter the crypto market, they also come with their own set of risks. Centralized exchanges are vulnerable to hacks, and there have been several high-profile cases where users lost significant amounts of money. Additionally, because these exchanges hold your private keys, you don't have complete control over your funds. That's why it's crucial to understand the risks and consider safer options for storing your crypto. There's a lot of cases where people have been SIM swapped, where people have just been phished, and all of their crypto were transferred into other wallets, and it's just gone, literally, blink of an eye. There's another way around this, which brings me to cold wallets. If you're serious about keeping your cryptocurrency safe, you want to look into a cold wallet. Unlike hot wallets, which are connected to the internet and are more vulnerable to attacks and hacks, cold wallets are offline devices that store your private keys securely. This makes them the safest option for storing large amounts of cryptocurrency, especially for long-term investors who don't need access to their funds frequently. Let's look at an option. This is the Ledger website. A Ledger wallet is a type of cold wallet, which means it's a physical device that stores your private keys just offline. Your private keys are basically like the password to your cryptocurrency. They're what you use to access your funds and authorize transactions. Keeping these keys offline in a cold wallet like a Ledger greatly reduces the risk of them being stolen by hackers or compromised in any way. The Ledger wallet is not connected to the internet, making it immune to online hacks. When you want to send crypto, you connect the Ledger to your computer or phone, but the private keys never leave that device itself. This means even if your computer is compromised, your keys remain safe. When you initiate a transaction, the details are sent back to that device. You then physically confirm the transaction on the device by pressing buttons, and the transaction is signed inside of that ledger using your private keys. And only the signed transaction is sent back to the blockchain. The private key itself never leaves the device, keeping it secure. When you set up your ledger, you'll be given a recovery phrase, a list of 24 words that serve as a backup of your private keys. If your ledger is ever lost, damaged, or stolen, you can use this recovery phrase to restore your funds on a new device. It's crucial to keep this phrase safe and private because anyone with access to it can control your cryptocurrency. Despite its advanced security features, the Ledger is designed to be user-friendly, with a simple interface and clear instructions. Even those new to cryptocurrency can use it confidently. In short, a Ledger cold wallet gives you the highest level of security for your crypto by keeping your keys offline and under your own control. It's an essential tool for anyone serious about protecting their digital assets. They have a ton of products. Me personally, this is the one that I use, the Ledger Nano X. You can get this in numerous colors. You can get it in plain black, you can get it in green, amethyst purple. I'm not going to name all the colors, but you guys get the point. You can even, I guess, control NFTs on here as well. That's interesting. I don't really buy into NFTs, just strictly cryptocurrency, because I understand it a tiny bit better. But point of the matter, I highly suggest a couple of things when using these wallets. Do not put your keys or any private information into a computer. Do not put your passwords into your computer. Write it down. Keep it somewhere safe. Don't even take a photo of it. If your goal is to use this particular asset in Bitcoin or whatever other asset in the crypto space to make yourself significant returns into the future and sort of compound your money over time, your best bet, keeping everything private. Keep every single thing private. Like I said, don't bring your devices out in public. Don't show people that this is what you're using. highly suggest keeping just every single thing offline, as this is what the core idea of what this device is used for, just keeping things safe and private. So like I said, Bitcoin is definitely an asset that I think a lot of people will benefit from. It's just understanding how it all works, right? Hopefully this video was helpful to you guys. If you guys did gain something from it, hopefully it creates a deeper sense of security in investing into the future of Bitcoin and cryptocurrency. Anyway, guys, I will see you guys in the next video. Take care.